Good morning and welcome to the inaugural broadcast of the Drilling and Production Outlook. My name is Richard Spears and this is my brother John, who will be taking care of everything from, well, once I leave the screen. Usually we would have gotten up early and you all would have driven over to one of the Hiltons in town or whatever the new place is we tried to start earlier this year. And we would be serving coffee and donuts. You're on your own to get your own coffee and donuts this morning. This is live, but immediately after we are done with this presentation, we will be posting this video on our YouTube channel, and so you can review it or you can share it with your colleagues. It will be available, and so if for some reason you have to log off and go somewhere else, this video in its entirety, along with the Q&A section, will be posted, and so you can review it at your leisure. My brother will be spending the first hour presenting the forecast. He'll go from the United States part to the Canadian part and then address the international part. You can ask questions just like in real life if we were there with you. You don't hold up your hand. There's two ways you can submit a question. If you're logged onto the YouTube thing and you're logged on as there's a chat feature and you can type your question in there, and Katie and Charlie and I will be reviewing those questions and we'll present them to my brother at the appropriate time. There's also another way. When you receive the email about the DPO and about this broadcast, there was a link there where you could submit your question on a form. And we would encourage you to do that, because otherwise, you use your Google code name, and so it's Harley Davidson 59 is asking a question about the Canadian drilling market, which is great. We'll honor Harley Davidson 59 and get there. But try either one of those. We'll be monitoring those and we'll submit them to my brother. So you can ask them as we go through here, and I may interrupt my brother as we go through, or we'll save them for the end, whatever's most appropriate. Anyway, my brother and I have spent the last 3 years in this room recording our podcast, and we have about 150 to 175,000 listens. Those podcasts are recorded, they're recorded live and then posted, and so we're very comfortable talking with each other. This is a little bit of a different format to do it live on video, but I'm sure that we'll get used to it, so forgive some of our technical difficulties that might be there. If there's an interruption in here somehow, the camera falls over or the Wi-Fi goes out, we'll hit a little screen that says technical interruption. Be patient, we'll get that fixed as quickly as we can, then we'll come back live again. So I think that I've covered the do's and the don'ts.
You're going.
So without any further ado, here's my brother John. Oh, by the way, this is a bison, and his name is DJ. It's the DJ Bison. So take it away, John.
Thanks, Rich. Appreciate it. Yeah, as Richard said, thanks for joining. Like many folks these days, we're finding new ways to stay in touch, and one of the advantages of doing this kind of a broadcast is we have a chance, I believe, to get some of our overseas subscribers to the DPO involved for the first time. So looking forward to that. Like Richard said, we want to take questions as we go, so we're very much in the moment as if it were a live broadcast. But there's also time at the end. I'll try and wrap up my comments around 9 and leave plenty of time for those who might want to, on their questions, to ask at the end, so that we can get those in as well. And then we'll, but like I said, we want to wrap up on a timely basis so folks can go about the rest of their business day, or if they have plans to hit the golf course, they can go. I know anyone who's golfed with Richard knows he's not much of a golfer, but it is easy to find him on the golf course. You just look for the Trail of the Wounded. So now with that, we'll get into it. I just want to hit some key points that will emphasize as I go through the presentation. If you have been following the news, there was just in the last day or so a story of a fellow who was a Buddhist monk, I suppose. He'd gone on a silent retreat starting in the early days of March, and he just came back out of that retreat just a few days ago, and of course his first question was, what did I miss? Well, if he had been in the oil patch, he would have looked at the futures price of oil and said, geez, when I closed the door and went inside, the futures price of oil was $41 a barrel, and today when I come back outside, I look at that futures price and it's still $41 a barrel, so not very much, I didn't miss anything, right? Well, that could not be more wrong. From a macroeconomic standpoint, of course, we're all familiar with the fact that that demand for oil has fallen tremendously, and we'll have some numbers that talk about how much that did go down. We believe it went down, but it's beginning to recover. It appears, and spot prices have come up. But I believe that the recovery in spot oil prices, and in the part of the early days of the futures curve anyway, has been primarily because of a very rapid and surprisingly strong supply response. So producers around the world have cut back production and much more quickly and much more aggressively than what folks had expected. But the demand forecast, anyway, is one that is also surprisingly bullish. It does remind me of, what they say about a second marriage, the triumph of hope over experience. And I think here that that may be some of what's going on with regard to the demand forecast. But we'll talk about that in a little bit. There has been sharply lower U.S. oil and gas production capacity, or that's what we believe given the outlook for drilling that we see. And to the extent that that does happen, I believe it's setting this industry up for a very rapid price response, probably in 2022. So we have a tough couple of years until we get there, but at that point I think the world will look much different from the standpoint of supply and demand. And finally, just some points about the exploration production market specifically. Operator CapEx obviously has been sharply revised. The base assumption, I think, for most of those revisions is that oil prices would stay in this $30 to $35 range if you're talking about WTI, $35 to $40 if you're talking about Brent. But that's been the kind of assumption that I think most operators have used when they've put together their drilling their drilling budgets and their capital spending plans this year and into next year. I don't think that it's likely that those budgets will be revised higher if oil prices are a touch above those estimates. So that's something I will be watching very closely, but from what I can tell, I think operators are going to be very cautious about following the price of oil up in terms of their spending plans. And finally, for those who follow the frac side or the completion side of the business perhaps more closely than drilling, it's clear that frac activity, at least in North America, has fallen much faster than even drilling has fallen here in the second half. But I believe at least that it sets us up for a possibility that there might be a little bit better rebound in completion activity as time goes by. So with that, let's get into a look at the global oil market. Now, this is a chart that represents what I believe, what I would consider to be the sort of the consensus opinion of the major agencies that track and forecast global oil demand and supply, showing that on the blue line that demand fell so sharply starting in the early days of 2020, but really bottoming out in April at somewhere around 75 million barrels of oil, and has begun to recover somewhere around 80 million barrels of oil consumption for the globe in May, and slightly higher again in July, again as these lockdowns end and as economic activity begins to recover. One of the things I should point out, though, and I want to make sure I leave with you, is that there's a tremendous amount of uncertainty around all these numbers right now. So, and these are key to not only our forecast, but what expectations are for oil prices. And so as we get a better hold of what has happened to demand and supply and what might happen to demand and supply going forward, I think we're set up for prices to move accordingly. it's interesting. I looked back a year ago. So the last hard number that you see on this particular chart are those numbers for March, where there's been a reasonable amount of information collected that allows folks to say, okay, this is what March demand and supply look like. Anything since then, April and May, even though it's history from where we stand in the first part of June, those are still just estimates. But March was sort of the last, most recent hard number that we have. So as a test, I went back to last year in June and looked at what the agencies, the International Energy Agency or the EIA in the US, what they were saying about global oil demand in March of 2019. And at that time, they were estimating that global oil consumption, March of 2019, was 100.8 million barrels a day. Now it turns out that the actual number for March of 2019 was 99.4 million barrels a day. They missed it by 1.4 million barrels a day. The expectation had been back then that demand was rising, and in fact it was falling. And if you will remember, the price of oil began to fall very sharply in the second quarter of 2019, and it was all because of this misreading of where demand was headed. And so that was at a time when the market was very stable. We weren't obviously going through a global pandemic, and so if it was hard to get the numbers right a year ago when things were fairly stable, imagine how hard it is to get the numbers right today when pretty much everything is in flux. So that's a key thing there. The point I would make also on this chart is that the red line, where we're talking about production, assumes that the OPEC Plus agreement, as it was structured in April, remains in place through the end of this year and on into 2021. Now, I know there has been some discussions among the OPEC Plus group about extending their cutbacks. So back in April, they agreed to remove 9.7 million barrels a day off the market in May and June, and then taper that to 7.7 million barrels a day held off the market in July, keeping those numbers through the end of this year, and then further tapering in 2021. So the discussion that's been occurring in the last week or so is, do we take that 9.7 million barrel a day taper from May and June and roll it forward? The Saudis have said, let's just hang on to that 9.7 million barrels a day and keep that off the market all the way through the end of this year. The Russians and others have said, no, we don't want to do that. Now it looks like they're just going to keep 9.7 million barrels a day off the market for just one more month, the month of July, and then begin to taper. So it's sort of a meeting somewhere in the middle on that particular point. But like I said, that wouldn't change the red line on this chart very much. But like I said, the base assumption is that that agreement will hold. Now, I've kept these numbers in place because I want to show you on our next chart what that means to inventories. But I think the inventory story would suggest that by the end of next year, probably all this discussion about OPEC plus, OPEC and Russia holding oil off the market will probably go away. So I see that one of the questions that come into us is, how do we see OPEC plus Russia unwinding their curtailments over the next couple of years? And I think, in fact, that this agreement that they have right now, as shown in this red line, that we'll probably see their efforts to hold oil off the market go by the wayside as we get into the second half of next year. And I think at that point, they'll see reasonably strong oil prices, probably higher than $50, and at that point they'll be happy to sell all the oil they can. So I think their primary focus will be on price at that point rather than share. But like I said, these are best guesses at this point, to be taken with several large grains of salt. I've also always say that petroleum economists exist to make meteorologists look good and to make sheep look like independent thinkers. So, so we should all remember that as we go forward. So we go to the next slide, which is our look at what is happening, what has happened, what will happen with regard to oil in inventory. And so this line traces what the growth in oil inventory, well, how it's changed going back since the start of 2019. Very little change over the course of 2019, but again, starting this year, given the mismatch, as we saw in the previous chart, between demand and supply, a lot of oil has gone into inventory, and that number will max out somewhere around 1.5 billion barrels of additional oil in inventory by the time we get into June and July, or through the middle part of this summer. Now, probably what's important is that to remember is that some of this will be captured or be held on offshore vessels. So it'll be seaborne cargoes. Part of it will show up in industrialized nations, this OECD grouping of countries, the Organization of Economic Cooperation and Development. And then the rest of it will be in non-OECD developing world countries where inventories aren't closely tracked. And roughly a third, I think, for these 1.5 billion barrels of oil in inventory. Now, it'll be the seaborne oil which I think gets used first. So as we see inventories being drawn down over the second half of this year, it'll probably be those high-cost seaborne cargoes which will where that oil will come ashore and be used. And so the official numbers that will get reported for oil stocks probably won't show much change, because oil held in tankers has never been closely tracked, and so we just don't see much of we just don't see those barrels very easily. The point that I would make is that, or I'm sure your attention has been drawn to, is on this chart. By the time we get into the fourth quarter of 2021, the line goes negative. We're beginning to pull oil out of inventory. Again, based on that assumption from the previous slide that demand was 4 or 5 million barrels a day higher than production because the OPEC agreement stayed in place. This is one of the, when I look at this inventory chart, the fact that it goes so sharply negative in the second half or the fourth quarter of next year really tells me that there'll be a lot of pressure on all producers around the world to bump up production because inventory draws of this magnitude will begin to be worrisome to markets and begin to push prices higher. So I think that's as I look at this chart, one of the things, if we're correct in terms of demand and supply estimates, the drawdown that will emerge in inventories, I think will push the OPEC plus groups to abandon their production restraint and open up the taps. Now, the issue at that point will be, where will the oil come from? And really, by the end of 2021, as we see it, the only spare barrels in the world will be those that are currently off the market in places like Libya and Iran. Libya because of their conflicts, Iran because of sanctions. And so there'll be, I think the world will struggle to supply the demand numbers that are likely to emerge if we go back on track concerning economic activity. If we don't, for example, have a second wave of lockdowns associated with the pandemic that reset oil consumption on a lower level. So with that in mind, one of the things we spend a lot of time here looking at is what's the outlook for U.S. crude oil production. Our drilling forecast incorporates now or ties into what that means for crude oil and natural gas output. And so on this chart, I'm just presenting what our numbers are based on our drilling forecasts and the estimates we made on frac activity and new well productivity and so forth, and how those numbers compare with the most recent forecast from the Energy Information Administration, EIA. So EIA in blue, our numbers in red, and as you can see, starting in the second quarter of this year, we're much more bearish in terms of oil production here in the U.S. than the EIA. And so there's a reason for that, I believe. I'll talk about that in a minute. I think the other thing that is clear is that they see production numbers flattening out in the early days of next year and then beginning to rise slightly as the year goes by. Our numbers would suggest that there'll be a further decline in U.S. production capacity throughout 2021 as well. So that's one of the reasons why I said that if we're right on the previous chart that oil demand and inventory is beginning to be drawn down sharply, there just won't be a 13 million barrels of oil from the U.S. like there was in the early days of this year. In fact, U.S. production will be somewhere in the 8.5 million barrel a day range. Will be, what is that, 4.5 million barrels a day less than what we were producing just a few months ago. Now, I think the reason that the EIA numbers are a little high for right now is that they are missing the shut-ins that are currently taking place. So this next slide looks at, again, these are just our numbers. The red line that you see here is the red line from the previous chart. In blue, what I have done is I've said, okay, if we weren't shutting in wells, if operators hadn't taken that decision, but instead we're just reducing their drilling activity, and with fewer new wells drilled and fewer new wells fracked, production begins to decline pretty rapidly. Here's the blue line represents what that production profile would look like just based on the drilling response and not including the shut-ins. Shut-ins are in red. And I think that the EIA in their current, most recent forecast anyway, is probably not including much of an estimate with regard to shut-ins, and that's one of the reasons why their production numbers are too high. In fact, there was a very interesting article just a couple of days ago where oil analysts had begun to ask questions as to about some of the reports, the Petroleum Supply Weekly numbers that the EIA was releasing, which seemed to suggest that they were overcounting U.S. oil production to the tune of about 1 million barrels a day. And I think that's right. I think that they use a model. The EIA uses a model to estimate weekly U.S. oil production for the most recent month. And their model is probably showing them numbers that look something like the blue line on this particular chart. And they're missing the additional shut-in production that is going on right now, and probably is somewhere on the order of close to 2.5 million barrels a day in the month of June. So, so I think that the EIA figures will soon be revised and come in much closer to the estimates that we've made for the second quarter and probably for the third quarter as well. Now, one of the questions I see that has come in is, with all this build-up inventory and associated costs, why is the price of oil still at $40 a barrel? It's a very good question, right? But I think the answer there is that the demand is so weak at this point that that it just doesn't. They need a low price in order to move and encourage consumption. The other thing that that is apparent if you look at oil inventory numbers over time and tie that back to what oil prices are, what you find is that that with the kind of inventory levels that we have, that oil prices go south and stay soft for a long time. This was the case in the 2015-2016 cycle in the industry. You remember those days, we had global oil production, the Saudis and OPEC decided to fight for market share. And so they opened up the taps and overproduced, ended up putting a lot of oil in in inventory. And oil prices, we remember, went from over $90 to 100, went down to below 60, went down to 40. I think somewhere ended up somewhere bottoming out around $30 a barrel. So anytime there's overproduction, anytime there's more production than consumption, and inventory numbers begin to rise, historically the market prices go south. So hopefully that's a good answer to that one. Our own estimates are, in terms of oil price assumptions, are shown on this chart. We're estimating that the average price here for WTI, the average spot price for WTI this year, will be right at $36 a barrel, and not much of a change for next year. Our average price is $37. The current future strip, which is what I typed in just a day or so ago, is actually a couple bucks higher than that now. We're seeing a WTI price for December of 2020 at close to $40 a barrel this morning, and closing in on $41 to $42 a barrel, if I remember correctly, as of December of 2021. So the market has begun to rally. They've clearly, in response to the agreement among OPEC Plus to hold some extra barrels off the market, and so pricing has come up. But one of the reasons we are not more aggressive on our oil prices, we don't think oil prices will bounce back higher, is again the 1 billion to 1.5 billion extra barrels of oil in inventory. All that is going to hang over the market for at least the next year plus, and that historically has proven to be a real problem in terms of pricing, responding and moving higher. So we've been very cautious about where we believe spot prices will go in the forecast that we have put together for drilling activity. But like I said, I think the elements are in place for a much stronger pricing environment come 2022. Again, U.S. oil production capacity down over 4 million barrels a day, and most of the rest of the world at that point, Saudi, Russia, all the big producers, pretty much maxing their own output at that time, and still coming up a tad short of where demand might be. So in those kind of situations, oil prices rise so that you can price some demand out of the marketplace. And I think that'll be the story that we see occur in 2022 and for years after that, for several years after that. So before we leave the U.S., I do want to talk some about gas production in the U.S. and the gas market here in North America, because what you see happening is that because of the impact on the economy, because of these virus-related shutdowns, gas consumption in the U.S. is expected to fall about 4% this year. It's nowhere near the hit that's been taken on the oil side, because so much of the oil consumption here is tied to transportation. 60% of the U.S. oil demand is related to the movement of people and goods. But on the gas side, 35% of demand is associated with power, another 30% is in industry, and those are down, but only slightly. So gas consumption in the U.S. is down about 4% this year, is projected to be down about 3% next year. Fairly reductions, but fairly small reductions. Also on the demand side, perhaps the more surprising thing, maybe not surprising, but certainly the more dramatic thing that's happened in the last couple of months has been the real slowdown in LNG exports here in the U.S. So the LNG market, export market, had been a very strong growth sector for the last couple of years and had been predicted to grow very strong once again in 2020. But again, with the hit taken to global economies, Demand for gas on a global basis is soft this year, and as a result, our exports of LNG to foreign countries is going to be disappointingly slow. So there'll be some growth, but it won't be nearly the growth element that had been forecast. The other thing, too, is that because oil prices have fallen, gas prices around the world has fallen. I think they're at historically low natural gas prices in both Europe and Asia at the moment. And that's also made it a struggle for U.S. gas to be competitive in those markets. So for a couple of different reasons, pricing as well as demand, our exports of LNG are expected to grow much more slowly this year than what had been forecast. So accordingly, then gas production in the U.S. is going to get softer. So here are our numbers, and in blue, the numbers from the Energy Information Administration. And as you might expect, similar to their forecast for oil production in the U.S., the EIA expects that here in the U.S., gas output will bottom out in the first part of next year and then begin to recover a little bit, while our numbers, in contrast, are expected to continue to fall, again, based on what we see happening to drilling activity and the decline rates of wells and so forth. This is, I do believe, and at the moment, that the EIA is incorporating the shut-ins that are taking place on the gas side. So because we have so much, about 15 to 20% of the gas that we produce here in the U.S. is associated gas that comes from the production of oil. So when you begin to shut in oil wells, there's an effective shut-in of gas taking place as well. And if we're shutting in today, or in the month of June, say, 2.5 million barrels a day of U.S. oil production, there's probably another 5 to 6 billion cubic feet of gas being shut in as well. So those numbers, I think, are incorporated. They're certainly incorporated in our forecast of U.S. gas production that you see on this chart, and I think the EIA is including them as well. Now, those shut-in numbers will mitigate as time goes by. We think that oil shut-ins will largely be a thing of the past by the fourth quarter of this year here in the U.S., and I think that gas shut-ins will accordingly be behind us by the time we get to the fourth quarter of this year. And so from that point forward, it's a function, gas production is going to be a function of how much drilling we're doing. So in any case, we see a tighter market for gas going forward. The problem will be for the balance of this year is that we just have an awful lot of gas in storage. We had a very warm winter. We've taken demand down a little bit in the first part of the year, and so as you can see on this chart with the line in black showing how much gas is in storage here in the U.S., we're well above the numbers from a year ago or 2018, and that means that there'll be a fairly slow a much smaller amount of gas re-injected from this point until, say, the middle part of November, when we're typically refilling storage in advance of the coming winter. So the refill numbers from this point forward this year look like 1,800 BCF or so. Last year, from this point to November, we put about 2,600 BCF of gas in storage. So our gas refill numbers are going to be down 35% or so compared to what we were last year, and that's just going to be a drag on the market from a pricing standpoint. Just don't see much of a way around that. So just as high oil inventories we think will suppress oil prices for the balance of this year and into next year, so long as we have high oil inventories, the same story should occur on the gas side, that we have high gas inventories right now, and that's going to depress gas prices for the balance of this year. So here's our forecast for gas prices. The Henry Hub spot price, we think, will end up averaging about $2 per million BTUs this year. It's been trading around $1.70, $1.75 for much of this second quarter. Not much change in the third quarter, we think. A bit of a seasonal recovery as we get to the fourth quarter of this year. And then next year, because our forecast is for a decline in gas production, a tighter market, we see gas prices rising. Our numbers for next year have gas prices averaging around $2.50 per million BTU, but for once in a very long time, we're actually more conservative than the futures market. Futures market, if you look today, has an average price of next year of somewhere in the range of about $2.90 per million BTU. So clearly the market is expecting to see a much tighter gas market next year. And if that's the case, anticipates that the price of gas is going to be bid up. So what does that mean then when it comes to drilling activity and rig count and so forth here in the U.S.? Well, as I'd said earlier, the operators spent the first days of March and April recasting their CapEx budgets based on this $30, $35 price assumption, and the net effect of that was basically to cut planned CapEx in half, so that relative to what they had expected, when anticipating that oil prices would be $50 a barrel. So that move from a price assumption of $50 a barrel to this $30 or $35 a barrel move, even though that was a price difference of 30 to 40%, it resulted in more than a 50% drop in CapEx budgets. And what that has meant is that rig activity has had to come down pretty sharply because, again, if you were planning on spending $100 over the course of 2020, 25 each quarter, you spent the 25 in the first quarter as planned, but then you said, nope, I'm only going to spend 50 for the whole year, and I've already spent 25 of it in that first quarter, so you have to reduce spending very sharply come the second, third, and fourth quarters in order to stay inside that new budget. And that's what's happened. Rig activity obviously has fallen tremendously. It'll average somewhere around 400 this quarter, we believe. The good news, I suppose, is that with the rapid change is largely behind us. I think most operators had wanted to get right-sized, if that's the good phrase, by June, and so that they could hit the level that they wanted to then maintain at for the balance of 2020. And so I think from where we stand today that there'll be a few more rigs come out of the fleet, but not a lot. We have a rig count at its bottom somewhere around 275 or thereabouts, and then holding it close to that level for the rest of this year. Averaging for the whole year 436 rigs, and then next year we start off again 275 rigs. As time goes by, if gas prices improve as we think, if the oil market begins to firm up, I think a few more dollars will flow back into the industry and activity will pick up as we go through 2021. But for the year as a whole, we see a rig count averaging around 290 rigs here in the U.S. next year as well. So year-to-year numbers would still be down. But from the start of 2021 and to the end of 2021, we think there'll be a slight bias upward in terms of oil prices. Now, in terms of rig activity, one of the things I'd said early was that, well, these budgets are based on a $30 or $35 price for oil. What happens if we get to $40 or maybe $45 a barrel, John? Will operators revise these budgets and spend more? And here is where I think we run up against the fact that the amount of, we have to take into consideration the amount of damage that's been done to balance sheets among operators here in the U.S. already. And so I think the first use of those additional dollars that might come from unexpectedly high oil prices will be that those dollars will be spent to reduce the leverage on the balance sheet, perhaps improve the dividend payouts or the profitability, the return on investment to their shareholders. And I think that'll be the first use of those dollars if, in fact, prices end up higher than what the budgets are based on. So I don't see much relief coming to rig activity in 2020 or 2021 just by a move to a $40 price environment, say. And again, I think the other thing too is that a number of operators, we've always talked about the bankruptcies taking place in the service sector. Same thing is happening on the operator side, and that is going to cause a challenge for how much activity might respond to higher prices. Again, I'm of the opinion that the industry, all the old relationships that we have used over time that track how rig count responds to changes in oil prices, I think those can be set aside now because we're in a new environment where operators are much more emphasizing profitability. And because of that, rig activity doesn't chase oil price changes nearly as rapidly, nearly as proportionately as it has been done in the past. And so with keeping that in mind, that certainly informed our view of how much rig activity might grow going forward. We just don't see activity being as proportionate to the change in oil price as what it has been in the past. And let me talk a little bit about what that means in terms of drilling activity. So we have a chart here in terms of new wells drilled. Total for this year we think will be around 9,600 wells. That's down more than 50% from last year. Last year we drilled a little over 20,000 new wells here in the U.S. And from those who are tied to the footage figures, about 138 million feet of hole. That's down about 50% from the last year's numbers. Next year, our forecast for wells drilled is around 6,300 total wells, so down about a 30% figure in 2021 from where we will be in total in 2020. One of the discussions that Richard and I have had, and we I think hold opposing viewpoints on, is regards the issue of drilling, maintenance, and completion budgets. So clearly, as operators have had to resize their organizations here in the second quarter, they've cut their drilling budgets, they've cut the budgets that they've spent on completing wells. And the third bucket that doesn't get nearly as much attention is the money spent to maintain older wells. So a lot of that maintenance is really operating expense to pay for power, to pay for pumpers at the well site and chemicals, the consumables element. But there's a portion of that maintenance budget that should be considered a capital cost in that it goes to repair equipment downhole or at the surface, or rework wells, refrac wells, and things of that nature. And so clearly, those monies, those maintenance CapEx budgets have dried up just alongside the reduction in drilling and completion expenditures as well. And we've seen it in the form of stories from the field where folks have said, wells break and they're no longer being maintained. They may be not shutting in the well, but when it breaks, they're not going out and repairing it and putting it back on production. So clearly, those maintenance dollars have gone away for a while. And in an environment when you're actively shutting down wells, then that makes sense. If we're right and the shut-in figures reach their maximum in June and then begin to mitigate, and as the market begins to strengthen and we get so that the shut-in numbers go away, then I think we'll first see some dollars restored to those maintenance CapEx budgets. Not a lot, but some. And so I think we'll begin to see more wells that have been broken get put back on production. Some dollars get spent to replace pumps or what have you. I think the next step is probably that we'll see some dollars begin to flow to the frac side of the industry. And And so that informs our forecast of frac activity. So as fast as rig count has fallen, frac activity has gone down even faster here in the U.S. The folks that count frac spreads have said that frac spread count has fallen from 300 or thereabouts to around 50 or so at the moment. So down by 85% or so. I mean, rig count is down 70%, so that is one thing to keep in mind. I think our estimate of frac jobs in the month of April, and certainly in the month of May here in the U.S., we're estimating that only about 300 frac jobs got started in the month of April, relative to around 1,100 or so that were being started in January and February, for example. So frac job count has fallen tremendously as well, and you can see our estimates on this particular chart. So we've got numbers down hard in Q2, only around 1,000 total wells having frac jobs being started in the second quarter. And so totaling then about, as you can see on the chart, about 6,700 total jobs in 2020, down almost 60% from what we were last year. So, and because frac crew count has fallen faster than drilling activity, the inference is that the number of DUCs, the drilled but uncompleted wells, have actually risen a little bit, right? You're fracking fewer wells than you're drilling, so the DUC count rises. And probably my back of the envelope numbers would say that the number of DUCs probably grew by fewer than 1,000, but 800 to 1,000 wells during the second quarter. So if I'm an operator and I'm sitting there thinking about what to do with the few dollars I have in my capital budget, and start looking right now, I say, I think I put frac crews to work fracking some of these DUCs rather than drilling new wells. And so that's one of the reasons why our rig count number is pretty much flatline from this point forward through the end of this year, but our frac crew count numbers go up a little bit. At least that's my thinking. Richard might come to a different conclusion. I think really the issue is just the speed of recovery on the frac side. But the other thing to keep in mind is that in the old days, so 2019, our estimate would be that about 90 days would elapse between the time the drilling was completed on a well and when it was fracked. So at any one point, in the normal working process figure, you had about a quarter's worth of drilling activity, a quarter's worth of wells that were drilled but unfracked. That was roughly 5,000 wells at a time last year. So we've gone from roughly 5,000 wells that were in that backlog of work, and now we've bumped it up a little bit. It's maybe closer to 6,000 wells right now. So there's a lot of opportunity for, I believe, for operators, if they have the cash, to go frack these drilled but uncompleted wells and bring them online. And I think we'll begin to see some monies flow to that process in the second half of this year. Does it happen at the start of the second quarter? Does it take the start of the fourth quarter? Does it happen at the start of the third quarter? Does it happen at the start of the fourth quarter? It's a good open question. We'll see. But I think that there's that opportunity, because at the current rate of drilling, at the current number of wells we're drilling here in the U.S. with 300 rigs working, we would normally then, the normal working process backlog would be maybe 2,000 wells instead of 5,000 or 6,000 wells. So we've got a lot of wells that have been drilled. Are they still economic at a $35 or $40 price? That'll be the challenge, and operators will have to sort through those to figure out which ones get put in the work plan for fracking. But like I said, we sort of have the three options at this point forward. Does frac activity stay below rig count like it did in the second quarter? Does it match the recovery in rig activity, or does it grow faster than rig activity here in the second half of the year? And I've opted for option 3 in this particular forecast, simply because we have this a number of candidate wells that might be fracked and brought online. So let's see if I can answer some of the questions that have come in. Wells drilled falls a lot more than oil production in the U.S. Why is that the case? So we have well count down by 70% or so, and oil production is falling, but it isn't falling that rapidly, and that's thanks to the 125,000 or so shale wells that have been drilled that are currently in production. And while those wells are declining, collectively these are old wells, the collective decline rates are on the order of 5 to 6% per month. And so production does come down, but it obviously doesn't fall as hard as rig count does, given the nature of the production rates. Now, obviously, we are deliberately shutting in wells, and that's taking some production offline for a few months here at present. But they'll get put back on production, and things will level out. It was interesting because we've had a number of discussions with folks, investors, service companies, operators, about what wells get shut in. We think of stripper wells, for example, those wells producing fewer than 10 barrels of oil, as being low volume wells but high cost. If I had to pick an average cost, I would say those wells are probably have an operating cost of around $35 a barrel. So if at a $30 price none of them are making you money, you shut them all in. Well, the problem is that there's a lot of stripper wells, but they don't amount to very much production. All the stripper wells in the U.S. collectively provide us only about 5% of the oil that we produce. So it's interesting then to talk to the bigger operators, because rather than tracking the production costs on a per well basis, they often, or more often, think of it in terms of on a sort of a field basis. I've got 1,000 wells in this field. What are the production costs? What's the average break-even operating costs for all of those wells collectively? Because I'm managing a field, not so much managing one well at a time. And so that's where things get to be a lot more complicated. But I think the fact that starting about a month ago, the industry became very concerned about having enough storage capacity, and you just had to shut in all kinds of wells, not just your stripper wells, but any number of high volume producers that might have still been making you money even at a $30 oil price, but you just didn't have a place to put the oil. So that is, those are some of the concerns that have come into to place with regard to production and how much production might decline. Let me go to the next chart, which is one about drilling and completion spending. So those who tied to the spending figures will see that collectively we estimate the total spending this year will be somewhere below or around $50 billion. We were at $119 billion last year. We're on our way to $36 or $37 billion in total spending next year. The numbers are just down, have had to come down extremely sharply. And so, as you can see from this particular chart, in Q3, as an industry here in the U.S., we'll probably spend about $8 billion to drill and complete wells. In the first quarter of this year, we were spending around $26 billion to drill and complete wells. So spend down on the order of about 70% from the end of last year to Q3. But we do, again, because we see a bit of a recovery in rig activity and a bit more dollars being spent from the Q3 of 2020 numbers until the end of next year, we see about a 30 to 35% increase in total dollars spent as time goes by. So we do see a bit of a recovery there as things normalize, as markets tighten, and as prices improve. One of the questions has been, what do frac crews look like going into Q3 and Q4 of this year? So if today we're standing at about 50 active crews, I think, and we were at roughly 300 wells in the month of May, probably fewer than that in the month of June. So I think, we're looking at about a 25% improvement in Q3 relative to Q2. So that would say that from where we are, probably we'll see frac crew count in the range of about 100, if you can trust those numbers. There's been a lot of discussion as to how much credit you can assign to frac crew counts, and so we're a little skeptical of that. But if we might be able to see the amount of activity from where we are in these current months double in Q3 and Q4. So a bit of an increase, but not a lot. So the next slide is one where we look at pricing, the price of new wells drilled here in the U.S. We've been doing this, collecting cost information on a quarterly basis back to 2008. And I've put the chart here, included this chart, because I think it's useful to think about how much pricing might decline relative to how much it declined in previous cycles. So as you can see here, this particular chart shows the decline in pricing that occurred back in 2008-09 when we went through that price collapse activity reduction. And then the next cycle that occurred in 2015 and 16. And so those two cycles saw pricing sort of on this index basis end up somewhere around 0.8. And I'm thinking that this time around, we'll probably see pricing go back to that kind of cyclical low. Anyway, that's informed our estimate of how much the cost of drilling and completing wells might soften over the course of this year. And so we have ourselves back at those previous cyclical lows this time around. So, and I think that most of that price adjustment, if we'll call it that, has occurred and will be in place as of the middle part of as of the second quarter of this year. I don't think we're going to continue to see prices weaken in the second half of 2020. I think at that point pricing will be lower but stable at that point. Now, one of the question is, let's see, what do I see here, Richard? Would the cost per barrel include of $35 a barrel, does that include drilling and completion costs? So I think this was regard to the operating cost of a producing well. So good question. Operating costs you can think of as having sort of three, but you've drilled the well. So no, it doesn't include drilling and completion costs anymore at this point. What it costs is the cost you're incurring to keep the well in production. And those sort of fall into three buckets. You have a consumables bucket, power, since most of them are on a pump, labor and supervision, chemicals, and so forth. So those consumables typically represent about half of the operating cost of an older well. You have another 10% or so that's associated with the repair and maintenance of the equipment you have on the surface. So not just your wellhead and not just your Christmas tree, but perhaps also your storage tanks, your heater treaters, those kind of, the field processing equipment. So there's a certain amount of maintenance associated with those, along with your communication systems, I suppose. And then finally, the other 35 to 40% is associated with the repair and maintenance of subsurface equipment. So there you've got pumps that fail, sucker rods that part, tubing that grows holes, all those things that need to be repaired. And those collectively represent about 35 to 40% of the operating costs of a well. The issue with that is that many of those subsurface costs are incurred, they're incurred not because of sort of routine maintenance, but because something fails. And so the well goes offline, rods part, pumps don't work, and now you've got to run out there and fix it. So you've got to hire a well service workover crew, who knows who else, pressure testing your tubing and so forth. All that has to be done, and so those costs those are very lumpy, whereas your consumables costs are incurred each and every day. Some of these subsurface costs are incurred sort of once a year or maybe once every 2 years, and that cost may come in the form of a $10,000 to $20,000 expenditure. So those kind of costs are, so the nature of your operating costs is important to keep in mind, because again, at the situation that many operators have found themselves in now, when a well breaks, he doesn't want to spend $10,000 to $20,000 or $30,000 to go get it fixed. He's just going to leave it offline and suffer the consequences in terms of production. So we also track land rig day rates. Here's a chart of those. They actually rose in the first quarter, but the expectation is that rig rates are going to fall at about a 10% clip going forward. I think that frac costs, for example, are probably down about 20% from the start of the year. So frac is one of those categories that's probably going to fall more in pricing than the average. Rig rates are going to come in pretty close to the average drawdown in prices. Kurt Minnick, Pipe Logix, tracks pricing for oil country tubular goods, and he reported that pricing in the month of May alone was down 4% to just below $1,200 a ton there. So, and the bad news is on the pricing for OCTGs, the pipe prices have now fallen for 22 consecutive months and are 31% below the cyclical high. So the pain is widespread across many different sectors in the U.S. oil patch, as we all know. So the next chart looks at the Canadian numbers. Canada, we think, we'll see rig activity average around 77 rigs this year, down about half from what it was on average last year. In the most recent months, we're seeing, recent weeks I should say, Canadian rig count's been 75% below where it was in the year ago week. So clearly operators up there have cut their spending and their activity pretty sharply as well, just as we've seen here in the U.S. And they've shut in about 1 million barrels a day of oil production up in Canada. So the Canadian production numbers are configured much differently than what we have here in the U.S. Canada has normally been running around 5.5 million barrels a day of oil production. 3.2 million barrels a day of that was from oil sands. 1.4 million barrels a day was from conventional and tight oil plays. And then you had another 800,000 to 900,000 barrels a day from gas liquids. So the Canadian operators have collectively shut in around 1 million barrels a day of production. Most of that, I believe, has come from their oil sands mining operations. So oil sands, like I said, accounts for 3.2 million barrels a day of Canada's oil production. It's roughly split 50-50 between mining operations and this in-situ steam-assisted gravity drainage production. The mining operations have an average cost of $25 to $30 a barrel. So that's pretty high cost production, and that's what the Canadian groups have shut in now. But the other takeaway is that tight oil production, which represents maybe 70% of the oil we produce here in the U.S., is maybe less than 20% of the oil that the Canadians produce. So their production numbers longer term, even with these kind of drilling rig declines, aren't set to fall nearly as far and as fast as what we see output here in the U.S. And it's just because tight oil up there is a much smaller piece of the overall production pie than what we have here in the U.S. Now, from a wells drilled standpoint, again, their numbers are down pretty sharply. Last year, there were about 4,700 new wells drilled in Canada. This year, there'll be around 2,700 new wells drilled by our lights. I saw that recently the Petroleum Suppliers Association of Canada, PSAC, had put out a forecast where they were calling for 3,100 new wells drilled in Canada this year. And so we're at 2,700, they're at 3,100, but both down either 30 to 40% from where it was a year ago. And then our numbers for next year would suggest that there'll be about 1,800 wells drilled in Canada next year, down about another 30%. So the Canadian market is another one that is suffering through tough times, as operators there struggle with the current price environment. Land rig rates, as you might expect, are also have begun to weaken. In the first quarter, average rig rates in Canada were just at $21,500 Canadian dollars, and that was down about 6% from the year-over-year numbers, so from the first quarter of 2019. So again, Canadian pricing for rigs has already begun to take a hit, and we think it's going to decline at about a 10% rate going forward. So the good news in all of this, the strongest piece of the puzzle, so by a fair amount, is the international sector. So again, international for us is rig activity, drilling activity in Central and South America, in Europe, as well as Africa, the Middle East, and Asia Pacific. We don't include China, we don't include Russia, we don't include Central Asia in these numbers here. We've got separate forecasts for each of those areas. But this international piece is one where, again, operators have revised their CapEx budgets sharply here in the second quarter. It's interesting to compare because here in the U.S. on average we've seen 50 to 55% reduction in CapEx spending this year. Internationally, the international oil companies, so the Shells, Chevrons, BPs, Exxon Mobils in the world, and so forth, have seen CapEx reductions on the order of about 30%. So 50 to 55% here in the U.S., 30% or thereabouts internationally. The national oil companies, I should say, really haven't released numbers, so we can't say much about what their CapEx, new CapEx plans are. But from the IOCs anyway, they're down as well. They're just not down as sharply as from a spending standpoint as what we've seen here in North America. Rig count is of course expected to drop. Our new number for 2020 is an average international count of 884. That's down 12% from last year. We are about 820 rigs on average next year, down another 8% or so. Some of the sharp drop that you've seen in the second quarter has been a function of shelter-in-place orders. So, for example, rig count in Argentina went to 0 in the month of April because folks were told to stay home, and that just shut down drilling activity. We lost 45 rigs there, a bunch of other rigs in other countries in South America. So rig count would probably have been 75 or so rigs higher in the second quarter were it not for these shelter-in-place orders as a result of the coronavirus. But that being said, they would have still been moving down. They just moved down a lot faster. There'll be some recovery, I think, in those rig numbers as the pandemic eases, but not much because the CapEx story tells us where activity is going to go, and that's all headed lower. Just not as much of a decline as what we think we'll see here in North America. Average new wells drilled, or total new wells drilled then, of course, falls accordingly. We think there'll be, in this international market, around 8,000 total new wells drilled this year. That's down about 20% from roughly 9,700 total wells that were drilled last year. We'll be down to around 7,500 new wells in the international market come next year if we're right on our forecast. What we're hearing from operators, what we're seeing them announce, and what the word is from their service companies is that a number of projects that had been poised for sanctioning, so they hadn't been officially approved yet, but they were getting close, that many of those will probably now face either a 3 to 6 month delay in sanctioning as operators rework costs, redesign, go back to service firms for rebidding, and so that they're just moving to the right on the timeline for many of these projects. But even those projects will be contingent upon the abatement of these virus restrictions, travel restrictions and so forth, because these are real logistical problems internationally. So many offshore projects have shipyards around the world building bits and pieces of their kit and then bringing them all together, and you've got all those places facing shutdowns because of virus-related restrictions. And as those spin back up, now you've got to begin to reassemble the new project timeline. And that's been an issue for many projects. And in fact, some operators have used that as reasons to outright cancel projects. So we've seen some of that. But I think even restarting the project sanctioning process will depend upon how quickly and the extent to which of these virus restrictions ease, and how well oil prices recover. Do they get back and stay above the $40 price? Day rates for international land rigs is something we've tracked for a long time. Again, they rose slightly in the first quarter of this year, but we think they'll decline. You know, international land rigs only began to rise in the second half of last year, and that was 2 years after the land rig cycle bottomed internationally. There were so many spare units that it was really tough for contractors to move rig rates up, and that only began to happen about 2 years after drilling turned up. Well, with drilling down sharply, it's only a matter of time before rig rates internationally also began to fall, and we think they'll begin to decline at a 10% clip. The same thing, of course, is happening offshore, and there we are hearing that rig rates, depending upon whether you're talking jackups where they fell by 6% or floaters where they fell by 10%, that those were the kind of declines that they saw in new contracts just in the month of April. So a lot of pricing pain being felt in an international sector as well, even though rig activity isn't down the extent to which we're seeing it fall here in North America. So let me just go quickly through then the individual regions in our international forecast. Here we have Central and South America, where we expect to see rig count down about 34% this year. The hard fall is taken in the second quarter because of these pandemic shelter-in-place orders. And so a bit of a recovery in the second and third quarters as those restrictions get lifted, but still down pretty substantially for the year. Good news, I suppose, is that in the case of Argentina, the government has recently announced above-market price support in an attempt to boost their oil sector there. So they've been talking about a $45 price for oil, for example, for the Creole barrel, which is what they call our domestically produced oil in Argentina. So the government's taken those kind of actions. It'll be interesting to see how quickly they might respond to that. Guyana has been a real success story, of course, for ExxonMobil and others, but even Exxon has cut its budget some and released a rig that had been scheduled to work there. Pemex in Mexico is one where the government has continued sort of its full support for plans for activity, and so actually we have Mexican numbers up year over year, even though Pemex as a company is the most highly indebted firm in the world, I've read. So how long that might be able to be sustained in the face of low prices will be a challenge, although we all have to remember that Pemex does a wonderful job of hedging its oil production, and so has been able to enjoy a much higher price than many other operators because of its aggressive hedging business. So in Europe, we're looking at about a 25% decline in rig count this year, somewhere around 59 rigs, active rigs on average, and 600 roughly new wells. The story for most service firms, of course, are concerned about the offshore sector, and there, of course, we're seeing in Norway reports that all non-sanctioned projects that had been scheduled for sanction in 2020 are probably all going to be pushed into next year before operators then take a decision to move forward with those projects. So there's just been the work that has been sanctioned and was underway is in place yet, but all those projects that had been teed up and ready to get started are now being pushed back a year in terms of sanctioning. And in the UK, same kind of story. The net effect in terms of their spending numbers is that for CapEx to fall 20 to 30% this year. And in each of these countries, as well as the other countries around the North Sea, there's some discussion about what to do around providing tax incentives or support for operators in order to maintain production. although that's getting to be a tougher story for many firms around the world. I think Richard is flagging me with a question that says, what is the ratio for rig count to wells drilled? Internationally, again, we have 880 or so rigs, and we have around 8,000 wells that we think will be drilled. So that works out to be somewhere around 9 wells per rig on average internationally. The number here in the US is much closer to 23, 24, 25 wells per rig on average than what you see. Part of the reason for that difference is that internationally a very high proportion of the wells that they drill are exploratory. Offshore, probably almost half the wells drilled are exploratory wells, and you're just going to go slower on an exploratory hole than you do when you're drilling a development well. So that's one of the reasons why the big difference exists in terms of productivity. The other reason, in the past anyway, has been that international wells tended to be deeper on average than wells drilled here in the US. But I don't think that's the case so much anymore, because we drill so many long horizontal wells here in the US that average well depth in North America and international is very much close to the same number, much closer than it ever used to be. So I think the big thing is, beyond just the issue of logistics and moving people and rigs and equipment around, is also the fact that exploration drilling is such a high part of the international market. Whereas here in the U.S., I think the official count is that only about 5% of the wells that we drill look like exploratory holes. So we just don't have that kind of factor playing a role in terms of drilling plans and whatnot. I want to go to Africa and look at our numbers there. Here we're seeing rig count fall down about 10%, we think, in this year in Africa. 130 wells, 1,000 new wells drilled, and so forth. Again, some high-profile well projects in this area that were coming up for sanction now have been postponed or maybe even outright canceled. BP had a project in Mauritania that has been canceled, as I understand it. There's been several projects in Angola and Nigeria as well. All these had a pretty high cost break-even point. But I think the other thing that is important to remember, one of the reasons we're not seeing quite the hit to activity internationally that we see in North America, is that in the international market, the government tax take is a much higher percentage of an operating cost or a field's economics than it is here in North America. So here in the U.S., you have royalties and production taxes, and those collectively are maybe 20% of the cash flow of a project. Internationally, you're looking at the government tax take being 70% perhaps, or such. So what that means is, if you strip out those government taxes and you say, geez, the actual field development cost may be $10 a barrel, a pretty low figure, but now you have to pay another $30 a barrel for the government tax piece, and so you get an overall economic break-even price of somewhere around $40. So, but those government taxes are on a sliding scale. So, all of that means is that there's lower direct costs for operators, and so as a result, there's more cushion in their capex plans than what you see here in the U.S., where a low price directly affects the cash to an operator, much more so than it is the case internationally. Middle East is once again pretty steady relative to everybody else. We're seeing rig count this year unchanged, 385 rigs, almost 3,300 new wells drilled, and so forth. I think it'll trend down a little bit over time. We've certainly seen operators there, Kuwait, United Arab Emirates, Qatar, and Saudi Arabia all talk about spending cuts. I think a lot of this is going to be in the form of looking for discounts from on existing contracts, but there'll also be some work that gets absolutely delayed. It's interesting the case, for example, of Aramco, where they're talking about cutting spending, but they want to protect their unconventional gas development, because there will be a big push. There is a big push to develop their domestic gas reserves, and so those kind of projects are being protected. But spending to maintain existing fields or maybe enhance their brownfield projects are ones that where spending is being slowed or activity is being pushed a little bit to the right, and where they'll take an opportunity to lower expenditures. So in each of these areas, it's not necessarily an across the board everything goes kind of hit to activity. Some parts of it will be protected. Then our final international area is Asia Pacific. Here again, we're talking about activity falling down, we think, around 10% this year, 184 rigs, 1,600 new wells, and so forth. This has been an area that has an awful lot of offshore activity, and there we've seen any number of stories about travel restrictions making it hard for contractors and service firms to move crews on and offshore platforms and so forth. And that's has had an effect in terms of taking activity down a little bit. And there have been a few instances where projects have been canceled or delayed as well. So all of this is beginning to play out here. But again, a lot of the drilling that takes place in this particular market is gas focused, and so oil heavy projects don't play as big a role in the Asia Pacific market as does gas. So that may serve to protect some of the planned activity and the ongoing work in this region. I see a question that's come in that says, which national oil companies do you see trying to maintain production for obligations beyond dollars per barrel, like local economy interests, declining mature fields, and so forth? Yeah. So I think that almost all of them will try and maintain production for that. When you look at, for example, the OPEC Plus agreements to cut production, what you really see is that Saudi, Kuwait, and UAE have carried the heaviest burden there. They've been the ones that have been the most willing to restrict output in an attempt to sustain prices, and that places, other countries haven't really had to do much of a cutback, and some of them haven't done any cutback at all. Like, for example, news has been about Iraq and the fact that it has almost completely flouted its cutback numbers in the OPEC Plus agreement. Nigeria has been another one that has been basically given a pass in terms of how much oil it produces. So it's really these countries in the Middle East where there's been the flexibility and the willingness on the part of the governments and their national oil companies to restrict production. I think the rest of them are pretty much in the case of almost like an independent operator in the U.S. They want to produce 100% of the time. So I think that's guiding piece. It was interesting within Russia. So the recent news was that about half of the operators in Russia are willing to restrict production, but the other half were not. They wanted to see that the Russia's agreement to restrict output be waived, and so that they could go back to their planned level of production and activity and so forth. So even in a big country like Russia, you see different oil companies with different responses to the notion of, do I maintain production, or am I willing to take a production hit in order to try and boost prices? Do I see local content requirements being eased in these countries? Yeah, so this is a good question, because in many countries over the past 5 years, we've seen a big push being made to try and increase local content. And I don't see it being eased very much by the government side. And I really think on the operator side too, that this whole notion of being a good corporate citizen is probably going to keep them sort of moving forward with efforts to use more local content in their either operations or in their capital projects as well. So local content easing would help some in terms of project costs, but I think the bigger issue there is really design. And can they find ways to redesign projects so that total capital costs are lowered? So it's not so much a local content issue as a project design thing. And finally, I want to go to our last slide, which is we want to make sure we don't forget to talk about China and Russia. Here, again, these are very opaque areas for us. We get some information, but it does come out slowly. But what we have heard, for example, in China, is that the three big national oil companies there, PetroChina, Sinopec, and CNOOC, are all talking about modest capex reductions this year versus what it was last year, and certainly what they had planned. They had been planning on increasing their capital spending because the government in China, anyway, had been putting a big push to increase domestic production of both oil and gas because it has become the largest importer of those products in the world, and it was concerned from a security standpoint about becoming so reliant upon imports. But in a low price environment, and the fact that there's surplus supplies of oil and gas, I think this push on the government's part for these state-owned companies in China to increase exploration and increase development efforts is being waived, at least for the time being, as they look to live within within cash flow. And on the Russian side, again, not a lot of new news coming in. There have been obviously some operators talking about plans to reduce spending. Lukoil and Rosneft, who are two of the big Russian producers, obviously Russian-based producers, are cutting output. But again, in Rosneft, it's protecting its plans to develop Samotlor, the big oil field in Siberia, and any new gas field developments that it has. Lukoil is another one where the greenfield projects remain on track. What it's doing is doing some cutbacks on its brownfield developments. And then Sakhalin, which is the high-profile international company working in Russia, has suspended some of its work on Sakhalin. So again, all these areas have bits and pieces of a story where cutbacks being done, but it's highly project dependent in the cases of China and Russia, I think. And with that, I have come to the end of my talk. I'll look to Richard and the crew here to see if there have been other projects or other questions weigh in. One question: why are natural gas liquids added to oil-weighted production to become liquids-weighted production? Yeah, that's a good question. So we had this. So natural gas liquids, to remind us all, are liquids that are extracted from the production of natural gas, and usually that production, that extraction takes place at a gas processing plant. And so it's just part of the magic of the industry that those barrels then get counted as oil production, even though all the production that accounts for it is all gas related, right? So I had this very long discussion with some very bright folks from New York who were trying to think about how much production was going to get shut in the U.S., and we talked about crude oil output to no end, and finally got to the question of natural gas liquids, and they were saying, well, can we just assume the same kind of production, response on the NGL side? And I was like, no, because that's all gas output. So it's a challenge there. And the other thing too is that the amount of gas liquids that get produced are dependent upon what the price of natural gas is. So this gas processing process itself, there's some leeway with regard to how much gas liquids you take out of the gas stream and how much you leave in, and that is an economic decision that in part depends upon the price of gas. So it's a real challenging thing for anybody to get right. Another question that's come in: are you factoring any deflation of supply chain costs in the investment outlook? So if we measure average spending per rig, how would you expect that to evolve? Okay, both good questions. Yeah, so we have included deflation estimates in our capital spending numbers, and so you'll see that we have, like I said, around a 12 or 13% decline this year, and because that decline is taking place in the first half of this year, and then we hold it steady through 2021. So our average in 2021 is a little bit lower than our average in 2020, but we don't think there'll be much change in pricing from the middle point of 2020 forward. So, but yeah, we do have tried to take a look at that, and in both, you know, what that means in terms of dollars and what that might mean in terms of activity. You know, the challenge that the industry has is right now is that you know, the best oil field area to develop land onshore U.S. is Permian Basin, and it's widespread. Break-even price is estimated to be around low $40 a barrel, $42, $43 a barrel. Now that's an average, and the lowest break-even prices might be 20% below that. So you may be looking in some operators, because of their situation, might have break-even costs of $30 a barrel or so for new spending. But that explains why oil rig count has fallen so hard. If we look at the overall drop in rigs that has taken place since the early days of March, where rig count's down about 70% here in the U.S., if you look at the oil rig count, it's down over 80%. Gas rigs have only fallen about 20% or thereabouts, so 25%. So the dynamics of gas versus oil, gas plays versus oil plays has certainly shown itself here, where pricing, break-even pricing in gas fields, particularly in the Northeast and Haynesville, is more in line with where the market is. Maybe the market is more in line with where break-even pricing is in those areas. And next year, an improvement in gas prices will help sustain or improve activity on gas drilling here in the U.S. as well. But that's been an issue for many companies. Do I see any long-term effects of COVID on supply chains, policy, impacting oil and gas? Well, I don't know so the issue about COVID, of course, has been that many companies, particularly maybe in the medical supplies area, have realized that they were maybe over-dependent on a single country, China, for their supplies. And when China ran into a problem, the whole supply chain for those types of products, you know, was impacted. And so I think companies and industries are beginning to think about or consider diversifying their supply chains, even though that's a costly exercise, because they don't want to. Because they've realized that the risk associated with becoming overly dependent on any one country. Now, I don't know what the numbers are in the U.S. with regard to how much of our oilfield equipment is sourced from China, but certainly big parts of it have been, and that might get reconfigured. But the fact of the matter is that over the next couple of years anyway, there won't be a lot of new capital equipment being purchased here in the U.S., be it rigs, be it frac crews or whatnot. So I'm not sure that the issue of supply chain rearrangement is going to have much of a role anyway over the near term with regard to the oil patch. Maybe once we're past this, we'll see some rethinking of that, but in the near term, not so much. Do you see any degradation in shut-in wells once they're brought back in? So this is a very interesting question, because when you talk to operators, they would say, yeah, we do a lot of short-term shut-ins whenever we're fracking nearby wells because of the issue of frac hits and so forth. And when we spin those wells back on, they're fine. They come right back to where they were before. These, however, are, what's to keep in mind is that these have been relatively short-term shut-ins, a couple of months perhaps, something like that would be typical. The issue that many people have discussed is, well, geez, what if I shut in some of these oil shale, or gas shale wells, but oil shale wells for multiple months? What might happen then? Can we take this experience about short-term shut-ins to avoid frac hits and apply it to a situation where we might be shutting in a well for 6 months? And there the question is more open. No one seems to know because no one has really done it. But one of the issues that I've read about anyway is that you shut in a well, one of these oil shale wells, you shut it in at the surface. You leave open the 50 or so frac stages that are down hole. And not all of these frac stages may have the same pressure. So over time, as you shut it in, that pressure gradient across those 50 frac stages should normalize, some being so that the higher frac gradient pressures go down, the lower ones go back up. You end up with this situation, I think the completion engineers call it a crossflow. And the question then is, what happens when you open those wells back up and try and produce? Does production take a hit? So that's the technical issue that I think most folks are aware of. What they don't know is what the actual result will be. So at this point, we have, like many others, have taken the short-term experience that there isn't a hit, and said, well, when the wells come back online, they'll be right back at it from the standpoint of output. Are we pretty much wrapped up on a question standpoint, Rich?
Well, I'm done typing the questions for you. Thank you for the incredible number of questions. This was far more questions than we normally get in public.
That's right.
Now, people linger after the meeting and they ask you questions.
That's exactly
That ain't going to happen on this one. But this video will be posted immediately after we close right now. We would like you to do this for us. Email Katie, email John, email me, email anybody in our firm, and let us know if this format worked for you. I think it did, but I'm a terrible judge. We'd like you to stay in touch. We answer hundreds or thousands of questions from clients during the course of a quarter, and we're here to help because that's what you pay us for. To end on yet another happy note, news this morning is that 2.5 million Americans went back to work this week, and we know that China's open. We know that Europe will open, because I would actually like to take that bicycle trip through Burgundy like I had to cancel for May. And oil demand will claw its way back up. It will take some time, but it is on its way up. And so that's all of those things are very good news for us. We thank you very much for supporting our firm during all these years. For the last 56 years. We'll be around for another 56 years. Although I guarantee he won't be doing this anymore. Anyway, thank you very much for being part of our meeting.